Hello, my name is David with DeepI Trading. Today, we're going to talk about candlesticks. And I'm not talking about the kind of candlesticks that you use for your birthday. I'm talking about, well, if you look over my shoulder, there's a pricing chart with a lot of candlesticks. Well, we're going to go through a little bit of the history of a candlestick, some interesting tidbits of information there. We're going to go through the anatomy of a candlestick. We're going to learn how to set up the candlestick in our Thinkorswim platform. Then we're going to talk about how to apply and use the candlestick as we're reviewing a pricing chart. And ultimately, we're going to add a little icing on the cake and talk about 3 or 4 patterns that are typically used and referred to when somebody brings up the word candlesticks. And with that, let's go ahead and get started. Let's talk about candlesticks. And I don't mean the birthday type, but rather the type we as traders use to evaluate a stock's price action. So let's begin with a little history of the candlestick. The candlestick was created about 100 years ago. To put that into some perspective, using the Dow Jones Industrial Index, in September 1923, the Dow was around 1,500 points. And by 2023, nearly 100 years later, the Dow was at a little more than 33,000 points for a rate of change at a little over 2,000% since the candlestick came into being. Not bad considering 100 years has gone by. A man named Munisa Homa, a rice trader who started tracking rice prices as it was being traded, is the person credited with coming up with the candlestick. During the development, Mr. Homa quickly realized the market movements were based on trader psychology. He realized that the price was moving because traders were acting on fear and greed and not on logical thought processes like most people had assumed. People are still the same, though. Traders still behave due to the same fear and greed they did many years ago. They still buy and sell for the same reasons, and markets still boom and bust for the same reasons. Now, let's move forward in time to about 33 years ago, or in 1991, when a guy named Steve Nissen wrote a book introducing the candlestick to the Western world. The name of the book, Japanese Candlestick Charting Techniques. Considering the New York Stock Exchange started around 1817, or more than 200 years ago, the use of the candlesticks to chart prices is a relatively recent idea. Let's talk about candlestick anatomy. It's pretty simple. There are 2 components, a wick at the top, bottom, or both ends of a body. The body can be noted in different ways. For DeepI trading, the green and red filled bodies will be used. However, candlestick bodies can be black and white, where the white body denotes an advancing condition and the black filled body denotes a declining position. The bodies can be unfilled, outlined using green and red. Let's break down the elements of the candlestick. When the stock market opens in the morning, the opening price is always denoted at the bottom of the body on an advancing day. The closing price at the end of the day is always denoted at the top of the candlestick body for what we call an advancing condition. A red body denotes a declining position, and when the bell rings in the morning, the opening price is denoted at the top of the candlestick body. And as the price continues to drop throughout the day, the closing day price is denoted at the bottom of the body for a declining day. Pretty easy to assess price movement with the candlestick, huh? So what are the little wicks at the top and bottom signify? The upper wick denotes the highest price during the day. It is the same whether a declining position or an advancing condition. The lowest point of the candlestick signifies the lowest price of the day or period being evaluated. So a candlestick provides a lot of information in something so simple. When a condition is advancing, many traders define this as a bullish condition, and when a position is declining, they consider it to be a bearish condition. Here's a little trivia. The term bearish came about sometime around the early 1800s when bearskin traders who shorted prices of bearskins were referred to as bearskin traders. Cuckoo, which eventually led to a shortened term, bear. Then, as time evolved, the idea of when a bear is in a fight tends to use its claws in a downward motion, while a bull, when fighting, thrusts his head and horns upward. The term stuck, and we still use them to this day. We can get all kinds of candlesticks. Fat ones, thin ones, tall ones, short, stubby ones, without wicks, wicks on the top and not on the bottom, or wicks of all lengths on the top and bottom. Candlesticks show emotion. They show emotion by visually representing the size of price moves with different colors and shapes. For example, a sudden large upward movement, a long green candlestick, might indicate a strong positive sentiment, while a large downward movement, a long red candlestick, might indicate widespread negativity. It can also show volatility by looking at the wick's length or the body width and the degree of movement during a day. The wick is always going to be the first point. It reveals impending weakness and decision or indecision, and more importantly, the extent of market sentiment. This is an example of a stock price over a month of trading, indicating significant volatility, as the price action can be seen to be inconsistent with literally any type of candlestick shape being presented in the chart. Tall bodies, short bodies, and generally long wicks. Candlesticks also show daily price movements. Of course, the high price, the lowest price, the opening price, and the closing price. The prices are always available for the history of a public company, and it's amazing. This is an example of an actual 5-year view chart of NVIDIA, a large tech company, where the data for every minute of every hour of every day of every month of every year, for the history of the public company is provided. We can zoom into any area of the chart for any day or period and evaluate the price action to better understand what has happened with the price over time, reflecting the market sentiment and market conditions. Arguably, some technical analysts suggest everything there is to know about a stock is included in these charts, which presumably reflect everything that has happened with the company or has impacted the company. Those are pretty big words. But of course, there's a lot of opinions on that issue. Before we get into the application of the candlestick in a price chart, let's set up the Thinkorswim platform to include candlesticks. This will be used throughout our trading experience. Now that we are set up to use a price chart in Thinkorswim using candlesticks, we can see the illustration in the illustration, the highest price of this stock during the particular day was $41.72. The lowest price was $39.81, or about a $1.91 difference for the day's trading range. Whereas the opening price was $40.84 to the lowest price of $39.81, or a little more than $1 lower than when the market opened. But during the day, buyers pushed the price upward to end the day at $41.59, slightly lower than the highest price, which was $41.72. The difference between the closing price and opening price for this particular day was a mere 75 cents. On a declining day, on the other hand, the price opened at the top of the candlestick body. The price continued to decline from the time the bell rang, and although increased a little during the day, ended up closing at $39.59, down about 52 cents more or less for the day. Do the sizes and shapes have any significance? If you see a wide body, you can assume a strong market sentiment. Buyers are interested, willing to pay the higher prices, moving the price upwards. On the other hand, a narrow spread indicates a weak sentiment. But we have to be careful with reading these candlesticks. A candle of the same type will have a completely different meaning depending on where it appears in the price trend. There are all different types, shapes, and sizes of candlesticks, all meaning something different. If you could visualize the overall trend of this company, Eli Lilly, a very large pharma company, the trend was clearly near a high when this candlestick was presented, and only 2 days later, the price started its reversal in a downward trend. Interestingly, this candlestick actually has a name. It's called a hanging man, and nearly always indicates a bearish condition is likely in a couple of days. In fact, that is exactly what happened. There are many forms of candlesticks, and most have a name applied, and some can be statistically relevant to traders understanding price action. However, if there was one important point to be mentioned as we close, it would be not to get stuck in the woods of the meanings of the various type of candlesticks. Use them wisely, look at them rationally, compare with previous time periods, and read them for exactly what they're telling you. They represent the buyers and sellers' emotions. Stay with your own plans regarding a trade, and always evaluate in the context of all other indicators being used in the valuation of a stock. Remember what Benjamin Graham said, one of the most famous and maybe the godfather of value investing. He said, buy when most people, including experts, are pessimistic, and sell when they're actively optimistic. That was a primer on candlesticks. I hope it was enlightening. I hope that it added some value and in your trading life, and in the future, I believe that is going to be one of the more fundamental parts of your chart analysis. Here at DeepI Trading, we want to thank you for spending your valuable time with us, and we'll see you on the next video.